Fortrea just delivered a mixed quarter, beating consensus on the bottom line, but slightly missing on top-line revenue, yet the stock actually reacted positively after the report.
Yeah, the market really liked this one.
They really did. So Q2 revenue came in at $678.2 million, and adjusted diluted EPS hit 23 cents. But the absolutely critical update here, and the whole reason the market is bidding this up, is that management increased their full year 2026 guidance.
Right, that's the real catalyst.
Exactly. They are now targeting revenue between $2,620 million and $2,690 million, and they lifted the floor on their adjusted EBITDA, bringing that profit target up to a range of $205 million to $220 million.
Which is a pretty bold move in this environment.
It really is. Okay, let's unpack this, because our mission for this deep dive is to help you, the retail investor, decipher the underlying health of this global contract research organization.
Yeah, you have to look past the headlines.
Right. We need to look right past that top-line revenue contraction and dig into the reality of their margins, their backlog, and what is, actually happening beneath the surface on their balance sheet.
And that top-line contraction you just mentioned, that is exactly where the central tension of this earnings report lies.
Absolutely.
Because when you look at the raw data, top-line revenue actually fell 4.5% year over year.
Which usually spooks investors.
Right. Usually it does.
Yeah.
But at the exact same time, their profitability metrics like EPS and their adjusted EBITDA margin are actually moving up.
Right.
So the initial takeaway for the market here is a distinct story of intense cost discipline and a raised outlook that is, well, effectively masking a slight dip in total revenue.
Right. Yeah, they are doing more with less.
Exactly. We are looking at a company trying to aggressively streamline its operations while navigating a very complex clinical trial environment.
Right, and since we've established that revenue is down while profitability is up, we logically have to explore exactly how Fortrea is pulling off that margin expansion.
We do. The details matter here.
They really do. Let's walk through those specific details. Revenue dropped from $710.3 million in Q2 of 2025 down to the $678.2 million we saw this quarter. However, their adjusted EBITDA actually grew 6.9% to hit $58.7 million.
Which is a solid bump.
It is. That means their adjusted EBITDA margin expanded by 93 basis points. Basically nearly a full percentage point of improvement, landing at 8.7%.
Right.
And just to put the bottom line into perspective, this quarter they reported a GAAP net loss of $13.2 million.
Which doesn't sound great at first.
Right. I mean, losing $13 million is a bad day for you and me. But you contrast that with the absolute massive $374.9 million net loss they took back in Q2 of 2025, and it looks like night and day.
Oh, absolutely. Management is probably popping champagne over that kind of year-over-year improvement.
Right. It's a staggering difference on paper.
It is, but you have to look really closely at what actually drove that previous loss.
Exactly, and that's where I have to push back on this narrative just a little bit.
Let's hear it.
When we look at that massive net loss from last year, a huge chunk of that was a $309.1 million non-cash goodwill impairment charge.
Right, the goodwill write-down.
Yeah, basically they had to admit that past acquisitions or assets they bought just weren't worth what they originally paid for them.
So they have to write down the value on the balance sheet.
Exactly. It's an accounting reality check, not actual cash walking out the door. It was a classic kitchen sink quarter where they cleared the decks of all the bad news at once.
Just get it all out of the way.
Right. So my question is this 93 basis point margin expansion a sign of actual grinding operational excellence, or are they just looking really good right now because they have incredibly easy year-over-year financial comps to beat?
Well, look. What's fascinating here is that while those year-over-year comparisons are definitely flattering because of that prior goodwill impairment, the operational improvement underneath it all is, in fact, very real.
Really? So it's not just a math quirk?
No, it's not just an accounting illusion. It's the direct result of targeted execution. Management explicitly confirmed in this report that Fortrea is entirely on track to deliver its full year 2026 cost optimization targets.
Okay, what kind of numbers are we talking about there?
We are talking about $70 to $80 million in gross savings, which translates to roughly $40 to $50 million in net savings.
But what does that actually look like in the real world for a contract research organization?
Well, it looks like a fundamental restructuring of their footprint. You have to remember, Fortrea was spun off from LabCorp.
Right, that was a huge corporate move.
Exactly. And when you go through a massive spinoff like that, you inherit a lot of bloat. You end up with duplicated IT systems, redundant project management layers, overlapping physical facilities.
Right, you have two of everything.
You do. So to get those savings, they aren't just arbitrarily cutting headcount. They are actively consolidating physical clinical testing sites.
Oh, I see.
Yeah, they are digitizing patient data collection to reduce manual labor hours. They're streamlining the very infrastructure of how a trial is actually monitored.
So they're genuinely figuring out how to do more with less.
Exactly, which is how you manage to wring out a 6.9% increase in adjusted EBITDA while your top-line revenue is shrinking by 4.5%. It's a true structural reset of their cost base.
Okay, so they're trimming the fat today to protect the bottom line.
Exactly.
But, you can't just cost-cut your way to long-term growth. Eventually, a CRO needs new science to test.
You definitely need revenue coming in the door.
Right. Are biotech companies actually knocking on their door right now? Because for a company managing multi-year clinical trials, investors are always looking at the horizon. You need to know what kind of work is coming tomorrow.
Which logically drives our conversation straight into their forward-looking demand metrics.
Exactly. Which means we need to talk about their pipeline. Let's lay out the numbers.
And the pipeline metrics are arguably the most critical part of this entire earnings release.
I agree. So Fortrea posted a book-to-bill ratio of 1.06x for the quarter.
Solid.
Yeah, and if you zoom out, their trailing 12-month book-to-bill is 1.12x. This marks 4 consecutive quarters where they have printed a ratio above 1.0x.
Which is exactly what you want to see.
Right. That brings their ending backlog to a massive $7.8 billion, which is up 3.3% year over year.
A very healthy backlog.
It is, and buried in those highlights is a really specific, critical number, a 19% year-over-year increase in first-half net new business awards, specifically noting growth into the biotech sector.
That biotech number is huge.
It is. Now, here's where it gets really interesting. I like to think of this book-to-bill ratio like a giant reservoir.
Okay, I like a good analogy.
Right, so you have water, which is new clinical trial contracts flowing into the reservoir at a rate of 1.66, while the water flowing out, the completed work they are actually billing for, is at 1.0.
So the reservoir is slowly filling up.
Exactly. But when I look at the presentation's specific burn rate metric, it's just hovering right around 8.6%.
Right.
It was 8.2% last quarter, 8.6% before that. That flow out of the reservoir is slow.
It is a slow drip.
So my question is a steadily growing $7.8 billion backlog actually valuable to you as a retail investor if the company's ability to convert that backlog into recognized revenue remains this slow?
It's a great analogy, but you have to look at how that slow flow functions over a multi-year timeline, right? And you have to factor in the nature of the clinical trial industry itself.
Okay, walk me through that.
A steady 8.6% burn rate on a base as large as $7.8 billion is actually highly valuable because it yields incredibly predictable compounding cash flows.
Predictable is good.
It's great. Clinical trials for, say, a new Alzheimer's drug or a complex oncology treatment, these are not quick, agile projects.
Right, they take forever.
They span years. They require intricate patient recruitment, long-term safety monitoring, and massive regulatory compliance.
You can't rush the FDA.
You really can't. So an 8.6% burn rate isn't necessarily a failure of execution. It means Fortrea has a very clear, stable, multi-year line of sight into its revenue recognition.
So it's a feature, not a bug.
Exactly, it's a feature. But to your point about the new business, let's talk about that 19% spike in first half net new awards, specifically from biotech.
Yeah, why is that so critical?
Because this isn't just numbers on a spreadsheet. This is arguably the most crucial macro indicator in this entire report, and it's a signal for the whole sector.
How so?
Biotech companies rely entirely on external capital like venture capital or public markets to fund their research. For the last couple of years, with interest rates elevated, that funding environment has been incredibly tight.
Right. VCs basically closed their wallet.
Precisely. You had a lot of biotech startups just trying to survive on the cash they had, pausing new trials entirely.
Like hoarding cash.
Yeah. So Fortrea, seeing a 19% bump in biotech awards, signals that funding constraints might finally be thawing.
Oh, wow.
It tells you that venture capital is opening its wallet again. Biotech firms are raising capital and immediately deploying it into new, real-world clinical trials with CROs like Fortrea.
That is a massive leading indicator for future revenue.
It really is. It shows the ecosystem is waking up.
Okay, so the future demand looks solid, and the macro environment for biotech might be warming up. But executing on a $7.8 billion backlog requires serious capital today.
Yes, it does.
You can't run global clinical trials on just the promise of future payments. We have to transition from future revenue to current liquidity and face the realities of their balance sheet.
The balance sheet is where things get complicated.
They really do. Let's run through their liquidity profile. For Q2, operating cash flow came in at $28.9 million.
Okay.
After factoring in capital expenditures, that left them with $19.9 million in free cash flow.
Not a ton of cash.
Not a ton. Then you look at the debt. Gross debt is sitting at $1,066.3 million.
Over $1 billion in gross debt. Yep. Subtract their cash, and you get a net debt of $897.7 million, which leaves them with a net leverage ratio of 4.3x.
Which is a number that certainly warrants attention.
Definitely. And we also need to look at how they bridge their $13.2 million GAAP net loss over to their reported adjusted net income, which is a positive $22.7 million.
The famous non-GAAP adjustments.
Right. The reconciliation tables here are really heavy. They are adding back millions in restructuring charges, disposition-related costs, one-time spin-off costs, and over $12 million this quarter alone in stock-based compensation.
Like a lot of adjustments.
Honestly, looking at Fortrea's financials feels a bit like buying a house with major deferred maintenance because of its complex spin-off history from LabCorp.
It's a good way to put it.
They are constantly adjusting for the cost of separating from their former parent company. So I have to ask, are retail investors getting an accurate picture of actual cash generation when tens of millions of dollars in restructuring stock-based comp and these endless one-time spin costs are continually added back to arrive at that adjusted EBITDA number? This raises an important question, and it's one every retail investor needs to ask when looking at heavily adjusted earnings.
Yeah.
You absolutely must scrutinize these non-GAAP metrics. Companies use them to show what they believe is their core operational performance.
They want you to see the shiny version of the house.
Right. They want you to see the business as it will exist once the dust settles.
Mm.
But those adjustments represent real cash leaving the building.
Or real dilution.
Exactly. In the case of stock-based compensation, it is real dilution for you as a shareholder.
Right. Paying your executives in stock might not cost you cash today, but it slices the pie into smaller and smaller pieces for the retail investor.
Exactly. Now, regarding their balance sheet, the 4.3x net leverage is certainly something to monitor, especially in a high interest rate environment.
Definitely.
But it is currently manageable because they have $616.3 million in total liquidity. That's their cash on hand, plus their available revolving credit facility.
So they have some breathing room?
They have a buffer to execute on that backlog.
Yeah.
However, your deferred maintenance analogy is spot on.
Thanks.
Because what does a spin-off actually cost? It means untangling years of shared HR departments. It means building entirely new, independent IT infrastructure from scratch because you can't just use the parent company's servers anymore.
Right. You literally have to buy your own servers.
That takes time and serious cash. But for Fortrea's margin expansion story to be truly sustainable in the long run, these quote-unquote one-time spin-off costs and restructuring charges must eventually drop off the income statement.
They can't last forever.
You cannot be in a state of perpetual restructuring and claim those costs are anomalous. Eventually, the house has to be fully renovated, the IT systems have to be built, and the GAAP numbers need to start converging with the adjusted numbers.
Exactly. The renovations have to finish at some point. So factoring in that leverage, heavy adjustments, and the cost-cutting margin story, we now have to look at how management synthesizes all these elements into their outlook for the rest of 2026. And importantly, we need to look at the forward-looking risks they are legally required to flag for investors in these documents.
Always read the fine print.
Always. CEO Anshul Thakkral's commentary was very measured. He emphasized disciplined execution and called this a strategic journey towards sustainable growth.
Standard CEO speak.
Sure, but as we established right at the top of the show, they actually raised their full-year guidance, specifically lifting the floor for adjusted EBITDA from $190 million up to $205 million.
Which is a very confident move in this environment.
It is. But then you read the fine print in their forward-looking statements disclosure, and they list some very notable specific risks.
What kind of risks?
They explicitly warn about macroeconomic deterioration, specifically in pharma and biotech. They warn about the risk of backlog cancellations, the danger of underpricing contracts, and the potential for cost overruns.
Oh, wow.
Right. So what does this all mean? We have a glaring contradiction here.
It seems like it, yeah.
Management is projecting high confidence by raising their guidance floors, yet their risk disclosures are explicitly warning you that they might severely underprice their multi-year contracts or see their massive backlog suddenly canceled. How do we square that?
If we connect this to the bigger picture, you have to separate the legal boilerplate from the operational signaling.
Okay.
Let's look at the guidance first. Raising the EBITDA floor by $15 million is a massive, tangible signal to the market.
Right.
It tells you that management isn't just hoping to achieve those $70 to $80 million in gross cost savings. They are signaling that those savings are already largely executed and effectively locked in.
You wouldn't raise the floor if you were just guessing.
Exactly. You do not raise the floor of your guidance if your internal cost-cutting measures are unstable, or if you think a major client is about to jump ship.
Okay, so the guidance raise is the reality, and the risks are just lawyers being lawyers.
Not exactly. The risks are very real mechanics of how a contract research organization operates. Take the warning about underpricing contracts or cost overruns.
Okay, how does that happen?
Remember how we talked about trials taking years?
Right.
If Fortrea bids on a 4-year clinical trial today, and inflation suddenly spikes labor costs for specialized nurses 2 years from now, Fortrea could get squeezed on the margin of that contract.
That makes sense.
It's a structural risk of doing long-term, fixed price or capped price work.
You're locking in today's prices for tomorrow's labor.
Exactly. But that specific warning about customer defaults or backlog cancellations is the most vital one.
Why is that?
It serves as a stark reminder to investors that a CRO's fate is entirely tethered to his client's access to capital.
Ah, right, back to the VCs.
Fortrea is entirely dependent on biotech and pharma companies having the actual cash in the bank to pay them to run these trials. If the macroeconomic environment takes a sudden turn for the worse, say, interest rates spike again or venture capital completely dries up, those small biotech clients might literally run out of funding mid-trial.
And they just pull the plug.
And if that happens, they have to cancel the trial. That beautiful 1.06x book-to-bill ratio and that $7.8 billion backlog can reverse and evaporate incredibly quickly.
Wow.
It's the inherent vulnerability of the entire sector. The backlog is only as strong as the biotech client's bank account.
That tethered to their clients' wallets is something you simply can't ignore no matter how good Fortrea's internal cost discipline is.
Exactly.
Before we wrap up this deep dive, there is one final unexplored angle from Fortrea's presentation that I want to leave you with, and it has to do with how revenue is actually categorized.
That's a good point.
If you look at the revenue breakdown, they highlighted a category called pass-through costs.
Right.
In Q2, these pass-through costs accounted for $251 million. That is a massive 37% of their total revenue for the quarter.
It's a huge chunk of change.
It is. Now, pass-through costs are exactly what they sound like. They're things like fees paid directly to clinical investigators or the travel expenses for patients participating in the trial.
Yeah, logistics stuff.
Right. Imagine running a highly complex trial where you have to fly patients globally to specialized clinics for gene therapy, monitoring those plane tickets, the hotel rooms, the specialized clinic time. Those are all pass-through costs.
Right.
The catch is CROs typically do not earn a profit margin on these costs. They literally just pass them through to the client at cost.
They pay the airline, they bill the biotech company for the exact same amount.
Zero markup. So here is something for you to ponder as you look at the wider clinical trial industry. If clinical trials continue to become increasingly complex, requiring rare patient populations and much more expensive logistical support to run, could rising pass-through costs artificially inflate the top-line revenue numbers we see reported, while permanently compressing the overall margin percentage of the entire CRO sector?
It's a brilliant point because it fundamentally shifts how you evaluate a CRO's true growth.
It does.
You have to start distinguishing between revenue that actually generates profit for the business and revenue that simply passes through the bank account to pay an airline or a hotel.
Exactly. It completely changes the lens on what top-line growth actually means for the underlying health of the business. Make sure you follow the show for our daily earnings coverage so you don't miss our next breakdown.